higher for longer. That was really the takeaway from these Fed minutes. Very consistent with what Fed officials have been telling us all along. Why do you think we saw that sell-off in the last hour of trading yesterday? Do you think it continues today?
Very frankly speaking, Frank, I don't think there was too much surprise in those Fed minutes yesterday. So we have 3 weeks of data that has come in since the Fed minutes were being written. We had a core CPI number that came in at 0.2%. The employment cost index suggesting that wages are coming down. So there shouldn't have been much surprise that the Fed is really talking about inflation risk still being there at that specific point in time. And I think some of that risk has been alleviating since. And they're talking a bit about a two-sided risk to the economy. So I think the market was sort of underrepresented in terms of the growth sensitivity that I think were in the minutes as well. But we as UBS are not surprised to see tech stocks being selling off. They are very expensive at this point in time and obviously very rate sensitive at this very moment.
Yeah, you're touching on rates. I really want to talk to you about that. Looking at the 10-year yield, hitting pretty much a 15-year high. This morning, we were just talking about it. Here on CNBC, we've had a lot of technical analysts say that 4.25%, that was the area of resistance for the 10-year. We've obviously crossed that now. Where do you think it goes from here? How do you see it impacting other sectors beyond tech? Is there any sector that you think actually benefits from these rising yields?
We do think there are sectors that are benefiting from this rise in yields, but Frank, maybe let me first point on our outlook. So we do think that yields over the next 6 to 12 months are likely to come down. So again, I think there is a growth sensitivity that's starting to come in with the Fed. We had Williams out in New York at times the other day talking about sort of lowering interest rates as inflations are coming down and real rates are moving up. So I do think there is a sensitivity. I do think we're going to see Fed cuts next year that's going to bring the end of the long end of the yield curve down. However, in terms of the sectors that you mentioned, I think something like financials is definitely underestimated. So Eurozone banks 40% up on earnings, clearly a big surprise. They're trading at price earnings ratio of 6-7 times and is representing sort of broader value in equity markets. So some of the equity markets that we call sort of the laggards that has great value and that are really doing well in times also when rates are relatively high.
So, Mark, I think I want to put a finer point on that question about the 10-year. So 4.29, a 15-year high. I think a lot of people expected it to decline somewhat. But where do you see the area of support for the yields? Do you think it falls back below 4%, or do you think it hovers somewhere around 4.2?
We think it goes below 4% by the end of the year. And what I'd say is, so coming here from UBS Wealth Management, we'd say we have a lot of clients that are looking for long-term investment returns through generations. And when you're looking at 4.3% on the US 10-year, close to 6% on US investment grade, really already competing with what we think is long-term return on equities around 7% per annum, you're starting to get really good risk-adjusted returns. And a lot of our clients are starting to indicate they want to load up on bonds at these sort of levels. So we do find it relatively attractive, and it feels less of a gamble maybe than some of the expensive equity markets at this stage.
All right, so you were talking about the Fed looking at inflation. One area they look at is the cost of energy. But right now, we're seeing WTI back below $80 a barrel. You're actually bullish on oil. You think we're going to see record demand this month. We're already halfway through the month, and oil's falling on slower China growth. So what's the catalyst for record demand this month?
That's right, Frank. So we are very bullish on oil. We actually, if anything, we just increased our forecast from $90 Brent at the end of the year to 95. And we do think sort of the supply-demand balances are moving our favor. So first and foremost, we have close to 103 million barrels per day of oil demand. And that's a time where global supply is at a 2-year low from OPEC, essentially ensuring that the cuts are staying in place from their perspective. And that's essentially lifting prices because we see that inventories in all the different ways that we're measuring it is at very, very low levels. So at some point, we need to start to rebuild it. That'll bring back demand. China has been on the weaker side, but we have seen that the Politburo a few weeks ago has been indicating that growth will be stabilized. There's a certain sort of focus on that, and that will ultimately bring energy prices higher.
So you have a lot of confidence that China is going to be the catalyst for the oil prices to spike and demand to hit a record this month.
So we have more confidence in the global economy, which has been driven by a more resilient U.S. economy. But we'd also say we have faith in the Chinese economy delivering close to the 5% of the target. And as you mentioned just before in the show here, the premier was out indicating they want to do it. And in a more command-driven economy, we think they have all the tools to essentially do that.